Let's say you're a developer, right?
Yeah.
And you're putting the finishing touches on a big project. You know, we're talking like multi-million-dollar development, years in the making.
Long time.
And you're finally ready to see some return on this massive investment you've made. But then tax season rolls around.
Ah, the dreaded tax season.
And suddenly you're face to face with, well, the IRS, obviously, but like specifically their uniform capitalization rules, UNICAP.
Right, UNICAP. And that can be a tough one.
It can be a real pain. For those who don't know, and I'm sure a lot of you listening do, but just in case, what does UNICAP actually mean for someone developing a property?
Well, at its core, UNICAP impacts how you deduct those costs, those mini costs that go into producing real estate. We're not even just talking about the land or the building.
Right, there's so much more to it.
Way more. It's all those essential, but honestly often overlooked expenses. Think like interest on construction loans, any property taxes that you had to pay during development, insurance premiums too, architectural and engineering fees, even stuff like storage costs, equipment rentals.
It's everything behind the scenes that most people don't even think about.
Exactly. But it adds up.
Oh, for sure. So how does UNICAP actually affect these expenses?
Okay, so here's where it gets, well, tricky. Instead of just deducting these costs all at once, which, let's be real, would be a lifesaver in those early years of a project.
Yeah, you need every penny you can get.
Exactly.
Yeah.
But UNICAP, it forces you to spread those deductions out. Sometimes we're even talking over decades.
Decades. Seriously.
Yeah. Imagine, right, you take out a construction loan and you're depreciating that interest over like 39 years.
Ouch.
It's the government's way of, well, their idea is to match expenses to income, in theory.
Makes sense, but yeah, not ideal in practice.
Not always. And especially tough for developers, especially right now in today's economic climate.
So if you're a developer and you're dealing with UNICAP, where do you even begin to navigate this?
Well, most developers I know, they use what's called the avoided cost method. Basically, you look at all those direct and indirect costs that went into getting that property ready, for its intended use. That's where all those interest charges, property taxes, certain design fees, all those things come in.
And under UNICAP, these costs all get added to your tax basis, right?
You got it.
And then that basis, it's deducted, but gradually over time, offsetting your income.
Right.
So it's like instead of this gush of deductions when you need it, it's like a slow drip, drip, drip.
A very slow drip.
And that can be brutal for cash flow.
It definitely presents some challenges.
Is there any hope?
Well, that's what we're going to get into.
Yeah.
Because there is this potential game changer, a little known provision in the tax code that I think could provide some relief for developers, especially if they know how to use it.
So UNICAP, right. Major cash flow drag, especially for developers. But you mentioned something, a potential bright spot.
Right. It's called the small business exception. And yeah, for some developers, this could be huge.
Okay, so who qualifies as a small business in the eyes of the IRS? Because I'm guessing it's not as simple as, just saying you are one.
You're right. There's a formula. It comes down to your average gross receipts. Looking back at the past 3 years.
And what's the magic number?
For 2023, it's $29 million.
So if you're below that, you're golden.
Well, there are some other things to consider, but yeah, that's the main benchmark.
Got it. Hold on, back up a sec. Gross receipts, what does that actually mean?
Sure. So essentially, it's your total revenue before you deduct any expenses.
So just all the money coming in.
Yeah, exactly. Before you account for, all the costs of running the business.
Okay, so less than $29 million, you're good. Except you said there were some other things.
Right. So the IRS, they have these things called aggregation rules. Basically, they're looking at businesses under, common control.
So even if your main development company is under the limit?
Could be other related entities that bring you over.
Like what? What kind of entities?
Oh, let's say you have a separate management company. Or maybe you're involved with some joint ventures. Those can all get factored in.
Wow, okay. So this is definitely not a do-it-yourself situation.
Yeah, working with a good tax professional is essential here. Someone who really gets real estate development and all these specific tax rules.
Because I imagine messing this up could have some bad consequences.
Yeah, exactly. Better to be safe than sorry,
For sure. So let's say everything works out. You qualify for this exception. What are we talking about impact-wise?
It could be huge. Think about it. You finish this big multi-million-dollar development, and instead of waiting, decades to try and recoup those capitalized costs, you deduct a good chunk of them right away.
That's a lot of extra capital.
It really is.
Yeah.
And you can reinvest that, use it to pay down debt.
Or just have it for peace of mind. So, I mean, this could be the difference between like barely scraping by in those first few years and actually turning a decent profit.
You got it. But it's
Yeah.
important to remember that every developer, every situation is different.
So what are some of the things developers should be thinking about besides the gross receipts?
Well, I mean, accelerating deductions is great, but you have to analyze the full impact. Like,
Yeah.
what's your tax bracket right now? And are you going to run into problems with the excess business loss limitations?
Right. So many factors.
And this is another area where having a tax professional on your team is invaluable.
They can help you figure out if this is even the right move for you.
Precisely.
So you've talked to your tax person, right? And the small business exception, it's looking like a real possibility. What happens next?
Well, you have to make it official, right?
Okay, so how do you do that?
You have to file a form. It's called Form 31-5.
Hatchy.
Very official. Application for change in accounting method. And you send that to the IRS.
And this basically tells them that you're changing how you're handling some of these costs.
Exactly.
Okay, so when do you have to file this form?
Usually it's with your tax return for the year you're making the change. So if you're thinking about doing this for this year, well, don't wait too long.
Yeah, definitely talk to your tax professional sooner rather than later.
Absolutely.
Well, this has been great. I mean, this whole deep dive into this UNICAP thing, this small business exception, it's not something that most people even know about. It seems like a really valuable opportunity for developers.
It really is. And what I like about it is that it's not like you're trying to get away with something, right?
Yeah, it's not some kind of loophole.
Exactly. It's all above board.
Yeah.
It's just smart,
Yeah.
Utilizing the tax code in a way that really benefits you.
Getting a head start on those tax savings.
That's what it's all about.
And I imagine for a developer, especially in those early years, that can make all the difference.
For sure.
Well, listeners, I hope you've been taking notes because this has been a good one. But remember, we are not tax professionals. If any of this resonated with you, reach out to a qualified tax advisor and make sure this is the right move for you and your business.